as agreed, what I will do is provide an overview of my sense of where the profession is now in terms of the economics of monetary policy. I have some slides, and so let me see if I can share those with you. Let me see how to do this. Are you all right? So you should be seeing a slide, a title slide. Is that what you're seeing?
Yes, thoughts on the economics of monetary policy.
Good. Okay. Excellent. All right. So here are the subjects that I plan to go through in the next half hour or so. And then I look forward to having a discussion. I want to talk about the monetary policy transmission mechanism, which is always a focus of research and has been for many years. I want to say something about the tools of monetary policy, which changed a great deal during the financial crisis of a dozen years ago, and I think are still evolving. Especially here in the United States, we are continuing to evolve what we call the structural framework of monetary policy decision making. Then I want to take up two quite specific issues. One is the implications of persistently low equilibrium real interest rates, which for some purposes is a very good thing for the economy, but I think in the context of monetary policy creates certain challenges. And also the question of whether the Phillips curve is flat. In other words, the price setting mechanism is not responsive to the state of utilization of resources in the economy. And then finally, I'll conclude with a few comments on the current set of monetary policy decisions that we are now facing in real time in the US. So that's the agenda. Let me start with my observations about monetary policy transmission mechanism research. I would summarize the state of research in the following way. First, at the empirical level, what I find interesting is that not necessarily as a matter of research strategy, but more as a matter of findings, I think there is today less emphasis on the role of the traditional driver variables that we think of when we ask how central bank actions are transmitted to effects on real economic activity, namely interest rates and exchange rates, and correspondingly more emphasis on the role of asset prices and wealth. Now, this may itself be a reflection of the fact that we've been in a protracted period in which, in the wake of the financial crisis, in countries like mine, nominal short-term interest rates have been at or very close to the floor of zero, and therefore there simply hasn't been very much action in interest rates to look at. So any sample that's dominated by the last dozen years is not going to have a lot of interest rate movement there. Nonetheless, it's interesting that this is the way the empirical research is focused, and exchange rates, as you know, is that's a more complicated matter because it involves the relative movements in policy between two or more countries. Nonetheless, what I do find interesting is that in current quantitative empirical research, most of the emphasis seems to be on the role of asset prices, equities, for example, house prices, and also wealth effects. Now, at the theoretical level, the contrast that I see is in some ways a surprise to me. I see less analysis these days of the role of frictions and credit availability in the transmission of monetary policy. And I have to tell you that I find this surprising because if we go back a dozen years to the financial crisis and the sharp downturn in economic activity in many countries that followed it, much of the immediate reaction within the monetary economics community was to focus on financial frictions, as we chose to call them, and therefore on issues of credit availability. So I find surprising the fact that research in the field is now paying less attention to these kinds of frictions and issues of credit availability. And maybe other people in the discussion later will tell me that there's lots of research that I'm simply not aware of. But at least sitting here in the United States, that's my observation. Now, correspondingly, what I find interesting is that there is more analysis today of the implications of heterogeneity among different kinds of agents. And I find that very interesting. This is, in some sense, welcome to me. I am of a generation that grew up in the shadow of Jim Tobin many years ago. And certainly Tobin's work emphasized heterogeneity among agents. Some agents are credit constrained, other agents are not. Some agents have high marginal propensity to consume, others have low marginal propensity to consume. There are some agents have high risk aversion, others have low risk aversion. And so I've been very pleased to see that the current trend in research seems to be to take more account of these heterogeneities. Now, one thing that's continuing in the wake of the financial crisis of a dozen years ago is greater recognition of the growing importance of what we call shadow banks and even financial institutions that you wouldn't even call a shadow bank. Here is a chart that I took from a Federal Reserve Bank of New York publication some years ago, showing that in the years leading up to the last financial crisis, the shadow banking system, regardless of whether you choose to measure it gross or net, was growing much more rapidly than the conventional commercial banking system. This is in the United States. But then there was a reversal in the wake of the financial crisis. I was disappointed. I was trying to find, for purposes of this morning, an extension of this chart up through the present day, and I was surprised that I couldn't find it. Couldn't find one conveniently. It's easy enough to construct, but I didn't have enough time to do that. But I would be quite confident that if we extended this chart out another 10 years to get to the end of the 20 and teens, what you would find is a reversal in which the shadow banking system has once again expanded. So the old-fashioned analysis of the transmission of monetary policy focusing only on the banking system, I think, is a thing of the past, and that's probably a good thing. The final observation that I'll make is an expression of disappointment. While I'm pleased to see that research in the field is recognizing the growing importance of the shadow banking system, I've been disappointed, in all honesty, that research has not taken account of the growing importance, as I see it, of derivative financial instruments. In effect, we have diversified our research focus with respect to institutions, but not with respect to instruments. And I think that's unfortunate because in one market after another, the advent of particular kinds of instruments of a derivative nature, like credit default swaps, for example, I think fundamentally changes the way markets work and surely has an impact on the way in which central bank actions are transmitted to the non-financial economy. And so I'm hoping that over some period of time, research in the field will catch up with that. Let me now move on to the second issue on my agenda, which is these two tools of monetary policy that central banks around the world evolved during the last financial crisis. The need for doing so was pretty obvious. The short-term interest rates were down near the floor of effective floor of 0 or a little below even in some countries, but we can't push short-term interest rates in a meaningful way much below 0. And so there were two new tools of monetary policy. The one that I think has the greatest promise is large-scale asset purchases, and I put in question mark sales because I'll come back to that in a moment. First, let's make sure we know analytically what we're talking about. Picture an equilibrium in the credit market in which the downward sloping red line is the supply of credit instruments. Think mortgages, for example. Think any kind of, again, this is the market for private credit, so think of that as corporate bonds, think of it as mortgages, think of it as risky bank loans. And the upward sloping blue line is the demand for credit market instruments on behalf of both the public and the central bank. Well, what happened in the last financial crisis, for example, is that there was a sharp shift to the left in the demand curve for credit instruments, leading to a new equilibrium at point B with a substantially higher interest rate than before, and also a substantially lower volume of credit being extended. And when the central bank then would respond, as central banks did, by buying their credit, by buying in credit, the demand from the central bank, in effect, is added to the demand by private sector investors. So that represents a horizontal shift of the demand curve back to the right, so that the new equilibrium following the central bank's asset purchase is at point C, in which they've succeeded in bringing the interest rate down from where it was at this post-shock equilibrium B, and they've also increased the volume of credit. And if we think of that action as being transmitted to the non-financial economy, here's a standard IS curve in which the initial equilibrium of aggregate demand was at point A, the shock moved it to B, and the central bank action improved the situation back to C. Now, two things to be said about these asset purchase programs. One is that there's substantial evidence of effectiveness. Not everybody agrees. I could name friends of mine in the American monetary policy line of work who disagree, but I think the overwhelming consensus, and certainly my sense of the evidence, is that these programs were effective. Here is just one survey of evidence. This was put together in the wake of the initial movement of central banks. This was done by John Williams, who is now at the head of the Federal Reserve Bank of New York. And if you just scan your eye down this far right column, you can see that while the estimates differ widely, nonetheless, there's a substantial agreement that there was some effect. And then I believe that this there are two implications of the success of large-scale asset purchases. One is that the central bank should continue on with the policy, and indeed they have. So here in the United States, for example, the Federal Reserve is still buying assets, long-term securities, as a way of trying to keep long-term interest rates low. And indeed, during the onset of the COVID crisis in March of 2020, the Federal Reserve expanded that purchase program to include a small amount, only a small amount of corporate bonds. Most of what they have is mortgages. I think there are also powerful implications for the optimal size of the central bank's balance sheet. And so let me say something about that quite explicitly. Um, as I trust everybody knows, many central banks around the world have had enormous increases in the size of their balance sheets over the last 10 years or so. In the United States, we've gone from a balance sheet of the Federal Reserve under under $1 trillion to today nearly $8 trillion. So we've multiplied by the factor of 8. There is substantial discussion, or at least used to be, of whether central banks should go back to a balance sheet that was more like what they had before the great financial crisis. And my answer to that is no. I think we've established a new tool of monetary policy, and it should be available to use in both directions. So, for example, when the economy uh, was in the phase of buildup to the financial crisis here, and everybody understood that there were excesses in the residential mortgage market. And most people understood also that we were building new houses at a rate that was unsustainable and likely to create problems. There were several years in a row back in the mid 2000 and aughts when the United States was building new houses at the rate of over 2 million houses a year, compared to an equilibrium rate of household formation of maybe 1.5 million, uh, people suggested raising interest rates as a way of stopping this. And to quote what Ben Bernanke said at the time, raising interest rates is a very blunt instrument to use to resist an excess in one particular sector or one particular market. But imagine that back in 2005, 2006, 2007, imagine that the Federal Reserve had had a portfolio of mortgage-backed securities that it could have sold into the market to widen out the spread between mortgages and treasuries. Well, that wouldn't have been a blunt instrument at all. That would have been a very good instrument. So my sense is that we should not go back to a balance sheet of the size of what we had before the crisis. Instead, we should retain on the central bank's balance sheet a large quantity of securities and think of those as available for sale when it's necessary to exert a contractionary pressure on the economy. And for this reason, 6 weeks ago, I was very distressed to see Jay Powell, whom I otherwise like very much, as chairman of the Federal Reserve, explicitly eschewing such a policy action. Back in mid-April, Jay said that he didn't think the Federal Reserve would ever actually sell securities into the market. I think that's precisely wrong. I think the balance sheet should remain large. I think the point of keeping the balance sheet large is precisely to have available for sale securities that can be sold and that they would sell if necessary to arrest the development of the economy. Moving on, the second new tool that emerged for monetary policy in the wake of the financial crisis was forward guidance. Let me quickly distinguish how I think of forward guidance as distinct from the way in which I thought of large-scale asset purchases. The story begins in the same way. Here again is a supply-demand equilibrium in the market for private credit. Think of it as mortgages or corporate bonds. Same shock as before, but now instead of a central bank purchase, which shifts the demand curve back to the right, we have a set of announcements by the central bank which changed the terms of the arbitrage between, say, long-term bonds and short-term bonds, or between risky bonds and risk-free bonds. And instead of shifting the demand curve back to the right, this is now a vertical shift in the demand curve. Now, as long as the lines are drawn as linearly, then now what is this? I'm getting a request to annotate the shared content. I have no idea what this is.
We can see it very clearly, Professor.
Okay,
The graph is very clear with us. We are not getting any message.
Yeah, I had no idea what that request is. So as long as the lines are linear, you could say it would be empirically impossible to distinguish a downward shift from a rightward shift in the credit demand curve, but that this is only a simple representation, and of course, in a richer empirical specification, it's very easy to do that. Now, analytically, it's all okay, but I think, well, now let's see. Now what's happening? Well, now I seem unable to, whatever that was, Sharon, it has interfered with my ability to uh,
move to the next slide.
Here we go. Now, yeah, okay. Now I'm doing it. Okay. So here we go. And again, here's the same transmission to the main economy. Well, analytically, that's fine, but I think there are two problems. One is that in contrast to the substantial evidence of effectiveness of large-scale asset purchases, my reading of the evidence is that there's very little evidence that forward guidance has been effective. And I think there's a further problem, and that further problem is that it creates a temptation for the central bank to make statements that are not genuinely revealing what the committee plans to do in the future. That would be fine in the interest of transparency, but instead in a kind of intentional deceit to try to shape market expectations. And I think that's a recipe for a very bad road to follow, because ultimately that would lead to a loss of central bank credibility. So the conclusion I would offer is that yes, by all means, let's declare the asset purchase programs a success, and let's continue them and broaden them, but I'm very skeptical of a serious role for forward guidance. Moving on now to the conceptual framework of monetary policy decision making. Both here in the United States and elsewhere, we're using a form of inflation targeting. I've written substantially about my reservations on inflation targeting. I'm not going to dwell on the subject at this moment. If anybody wants to ask me about it, I'm happy to discuss it. Let me simply say that I think what we're doing in the US in this regard is a lot better than what we were doing 10 years ago. What's new here is our rethought framework for monetary policy decision making. And this was the result of a substantial effort that the Federal Reserve put in place several years ago under Jay Powell. Rich Clarida, one of my former students, who's now the vice chairman, was in charge of it. I'd say there are two, there's several aspects, but there are two that I take to be of principal importance. One is now that they are explicitly going to engage in time averaging of inflation targeting. And given that we have had a long series of years in which they undershot the inflation target, under the new framework, they are going to be not just tolerant of, but pleased by overshooting for at least some period of time. Now, the great ambiguity, of course, is that they did not say exactly what the time period was for the time averaging, But I think this is a significant development. The second element is that, again, in response to having undershot the target for so many years, they've been very explicit that this time around they are going to tighten policy not just in response to a forecast that inflation will go back to target, but only when they actually see it happening. Um, Whether that's a good idea or not, I'm not sure, because we all know monetary policy affects the economy only with a lag and affects inflation with an even greater lag. But nonetheless, I think it's an understandable response to this experience of year after year missing the monetary target, always in the direction of undershooting. What's also interesting in the context, at least, of US monetary policy is the movement toward a broader interpretation of the central bank's mandate. And there's a whole variety of considerations that the Federal Reserve is now at least supposedly taking into account, some of which we've had several years to analyze, things like macro-prudential considerations, but some of which are very new. So, for example, the Federal Reserve has now been very explicit that they are going to take into account a climate or environment dimension to monetary policy decision making, principle through the vehicle of understanding the risk that climate change poses for the asset side of the portfolio of the banking system. Well, at one level, it's easy enough to talk about this in the abstract, but I have to say that translating that into concrete action by central banks is something that remains to be done. And then finally, back beginning with Janet Yellen, but now continuing under Jay Powell, there is a notion that the Federal Reserve ought to take account of social and racial inequalities and issues of mobility in our economy. Um, the usual, once again, so far they've been rather vague, but I think the idea is that even if the labor force as a whole, on average, is fully employed, if there are specific racial or other social groups that are facing high unemployment, maybe monetary policy should continue to be expansionary. Well, again, we're going to find out what all this means. Moving to the next item, as I'm sure everybody in this group knows, we have had a sustained period of extremely low equilibrium real interest rates. Um, I am not going to get into the question of whether this will continue. As I'm sure people are aware, many economists believe that this will continue. It's a difficult forecast to make because the truth is we don't know, I don't think, why equilibrium real interest rates are so low. So if you don't understand why a phenomenon has occurred, then you're not in a very good position to predict whether it will continue or not. But I'm going to contemplate potential questions of what happens if it does continue. The most obvious one is that there is therefore, a greater frequency of any given central bank for any given inflation target finding itself stuck at the zero lower bound. Here in the United States, our interest rates have been effectively stuck at zero for 12 years now. Even if you go back to the liquidity trap chapter of Keynes's General Theory, I don't think he ever envisioned such a thing. The question that raises, and several people have raised it quite publicly, I think, for example, of Olivier Blanchard, question is whether this makes it worth raising the inflation target. I think so. I think that uh, if we believed that 2% was the right inflation target 12 years ago, we should not believe that now, because what we now know about the greater frequency of hitting the zero lower bound should surely make us aim for a higher inflation target, maybe 3%, maybe 4%. supervised several good theses on this recently. My political judgment, however, is that we will not do that, at least not in the United States. And say privately, I've talked to Jay Powell about that, and I just don't think there's for political reasons, I don't think there's a prospect of doing it. And then given that we won't, because I think we won't, there is a straightforward implication which is not very reassuring, and that is that because monetary policy will therefore be less capable of stabilizing the economy, there will be a greater need for stabilization from fiscal policy. And the question is whether that's politically feasible. And I will say right out that for the United States, I am highly skeptical. I think the current state of dysfunction in our legislative branch of our government is such that conceiving of fiscal policy stabilization in real time is really a stretch. So I think this is very unfortunate because it means that because of being stuck at the zero lower bound, increasingly monetary policy will not be able to do what we need done. And for political reasons, fiscal policy will not either. So I think this is not a happy prospect. Moving to the next item on my agenda, I think the most fundamental conceptual challenge of all facing monetary policy is the question of what if it turns out that the Phillips curve, for any variety of reasons, is really flat these days. Now, I'm sure everybody, I've already referred to the failure. Well, to begin, going back even before the post-financial crisis period, most economists in the developed countries anyway, including me, were very surprised at how little inflation declined during the period immediately following the great financial crisis. There was substantial and widespread unused resources, and nonetheless, inflation really didn't move much. And since then, many of us have been surprised, I have been, in what I've mentioned already, the inability of so many of these central banks to reach their inflation targets. In Europe, in Japan, in Britain, in the United States, we just keep undershooting the target. And as a result, empirically, evidence seems to point to a flatter Phillips curve. Here's a set of recent regressions, and as you can see, if you estimated the Phillips curve on a sample from 1960 to 83, you get this nice gray downward sloping line. If you estimate it on the sample of the next 15 years, you get this more heavily dashed line in which the curve flattened. And if you estimate the Phillips curve for the most recent sample of 20 years, you get this heavy, solid black line. And as you can see, if you can see visually, there is some downward slope of that line, but mighty, mighty, slim. And so for all practical purposes, the Phillips curve is flat these days. Now, I think this creates, if true, a very fundamental challenge for monetary policy, because if it's really true that inflation is not responsive to the state of utilization of the economy, then why is there any upper limit on the output target that the central bank should be seeking to achieve? Or to state it in terms of the labor market, why shouldn't the central bank be pushing the unemployment rate to zero? And who knows, maybe this is a logical way to think about the issue that I mentioned before, in which the Federal Reserve is now thinking about taking into account racial and other social issues in the US labor market. If we were having this conversation 15 years ago, And somebody from the Federal Reserve said that we want to push the unemployment rate down to the point at which the non-white unemployment rate is super low. Somebody would have said, well, that's bound to be inflationary. But what if it's not inflationary? Well, I think if if it really is true that the Phillips curve is flat, then almost everything that we think we know about the optimal design of monetary policy is gone. Having said that, however, I find it astonishing, and here I'm referring to the United States, how quickly the public conversation has turned from a debate over whether the Phillips curve is flat to concerns over potential reflation as the economy recovers rapidly from the COVID crisis, and especially if the Biden administration is successful in going forward with its infrastructure program. Now, finally, I'm aware that not everybody is interested in the United States, but I thought it would be just a glaring omission if I didn't say anything about the current state of U.S. monetary policy. So let me conclude quickly by referring to a few issues, and I'm, of course, glad to talk about it more. The first question, which is naturally on the table, is how soon the Federal Reserve should begin to raise short-term interest rates now that the economy is clearly recovering and recovering rapidly from the COVID crisis. And my answer is soon. I think much of the rhetoric of the Federal Reserve has become increasingly inappropriate and verges on forward guidance of the deceitful kind that I was referring to before. Monetary policy, to repeat, affects the economy with a lag, affects inflation even further with a lag. Unless we really do think that the Phillips curve is flat, I think they should get about soon moving away from super expansionary policy. The second issue that's on the table here is whether the interest rate that they are paying on excess reserves is going to be sufficient for the purpose of raising the federal funds rate, raising short-term interest rates, now that our federal funds market has really withered. For all practical purposes, the federal funds market, which they always used to use, has become vestigial. To look at it in an analytic form, here's a picture of the federal funds market that would correspond to where we are today, in which the supply of reserves is so far to the right in the diagram that we're way out on the horizontal part of the reserve demand schedule. And therefore, in order to raise the federal funds rate up from 0 to some target, say we have a new target of here, it would be necessary to have a really massive withdrawal of reserves from the market. Well, nobody contemplates that because we now pay interest on excess reserves, and now, in effect, the central bank will use the reserve remuneration rate to set a floor under the short-term interest rates, on the idea that no bank is going to lend to a risky customer at an interest rate lower than that at which it can lend safely back to the Federal Reserve. So the question is this new mechanism going to be effective? And my answer is yes. I've looked at it, and many others have, in more detail than I, and I am not concerned about the Federal Reserve's ability to raise the interest rate. The final question that I pose for purposes of the United States is whether our higher and continually rising level of government debt will create a fiscal problem for monetary policy, in the technical language of monetary policy. This is called fiscal dominance. This is something we've never seen before in the United States, but I remember it many years ago in Europe when I used to go visit countries like Italy or Spain, for example. Italy's a good example. I would be visiting years ago at the Banca d'Italia, and we'd be talking about monetary policy, and I'd say, well, why don't you raise the interest rate by 1% or so? And they said, well, we can't really do that because the government debt to GDP ratio is about 100%. And so every 100 basis points that we raise the interest rate increases the debt service component of the government's deficit by 1% of GDP. And in the context of the history of government debt, this is the ratio of government debt to GDP in the United States, and you can see why, um, outside of World War II, when they did have to stabilize monetary policy, this was just never a consideration for us. Our debt ratio fluctuated between, say, 25 and 50%. Well, it's gone up sharply in recent years. The pandemic recession has raised it back up to 100. And under the pressure of demographic trends, it's going to be going up quite a bit in the next few decades. And if the Biden infrastructure program goes forward, and especially if Congress approves the program but doesn't approve the taxes to go with it, that will cause I should say should have said this chart is from the Congressional Budget Office. So when it says projected into the future, that's not Ben Friedman projecting, that's the Congressional Budget Office projecting under current law. But if the Biden program goes forward, the purple line would go up faster. So the question is whether we in the United States are now going to be in a period of fiscal dominance of that form. And my answer, fortunately, is it may happen, but it's not going to happen for a while. And so if we have this conversation again in 5 or 10 years, 15 years, Sharon, you can invite me back 15 years from now. Fortunately, you and I will still be here and we will do this conversation again. And maybe then my answer would be different, but for the moment, I think we're not there. So let me finish and thank you very much. And